Much for joining us for today's webinar, where we're going to review the 10 questions to ask a financial advisor in 2024. My name is Jake. I'm a financial advisor at Savant, and I'm also joined by fellow financial advisor, Grant Moore. Hey, Grant, how are you?
Hey, Jake, doing well. How are you?
I'm doing great, doing great. I think this is such an appropriate topic. We always talk about, planning for the next year, doing our New Year's resolutions, and sometimes that is to seek financial advice. So I think the idea of thinking of the critical questions to ask a financial advisor moving forward, hopefully we can help, spur some of those different discussion points here today. So Grant, I'd like to start with you, and we think about a number of different questions as we move forward. The first question, I think, and most important to ask is whether the advisor someone might consider hiring as a fiduciary. So might you give us a bit more guidance on whether an advisor is fiduciary and really how to have that conversation?
Yeah, great point, Jake. I do think this is a wonderful starting point for anyone going through kind of the interview process with an advisor, is asking if they are acting in a fiduciary capacity. So we'll talk a little bit here about just the appropriate definition of a fiduciary. Really, a fiduciary is a person or organization that acts on behalf of someone else and puts their interests first. They are legally and ethically bound to make sure, again, that they are acting in accordance with that individual's, what's most important to them, making sure that they're not just simply selling them a product or service that might not truly be in their best interest. So when you're going through the interview process, it really is important not only to ask the question of, is someone a fiduciary, but here are a few other things that are also important. So first and foremost, in my opinion, working with an advisor that has the CFP, or Certified Financial Planner designation. This is kind of the gold standard in the industry, encompasses a lot of different topics, and it's usually about a 1.5 to 2 year long process to go through the full certification. So this is going beyond just the scope of investments, looking at things like estate planning, taxes, and insurance, for example, to provide more well-rounded advice. The second is that a firm is a registered investment advisor. So in order to be an RIA, you have to either be registered with the SEC or with your state registration as well. A third component is a firm that holds the CFEX certification. CFEX is an independent organization that's the Center for Fiduciary Excellence. So it's another way that a company goes through the vetting process to become CFEX certified. And finally, an independent firm, in my opinion, is important. So a company that's not necessarily affiliated with a bank, brokerage, or insurance company, really that doesn't have their own proprietary products to sell. I think that alleviates and eliminates a conflict of interest that might otherwise be inherent in our industry. And ultimately, why is a fiduciary important? First and foremost, non-biased advice, and it's not tied to compensation. Too often people think, well, what if my advisor or broker is recommending I buy a certain product? Is that because that individual receives a commission? Is it, something that's in their best interest, or is it in my best interest? And a fiduciary really does a good job of eliminating those conflicts of interest and increasing the overall level of trust that you have with that provider. And lastly, I always say a fiduciary is someone that is standing in your shoes, looking through your eyes, and making investment and financial planning decisions as if they were doing them for themselves.
I think that's super important. And, when you think about questions, I also be remiss if I didn't mention that if there are other questions beyond the several we're going to review today, any of the participants that are on our call today can use the Q&A button, which should be located somewhere at the bottom of the screen, where if you have another question you feel like we're not going to actually answer today, feel free to submit that question through there. We'll spend a few minutes towards the end of this presentation answering some of those questions as part of our session. Grant, thinking about kind of the second question, right? Pivoting from just the table stakes, in our opinion, of being a fiduciary and in this industry, really getting into the meat of the investment philosophy is super important, right?
Absolutely. So, there's a lot of different opinions as to how a portfolio should be constructed. And it's, really important that your provider has research, has, kind of a thorough process for determining their investment philosophy and helping clients through that. And again, just kind of comparing what is available, what the other options are. So really, there's two main reasons when we're looking at different approaches. Kind of the conventional investor that we've become familiar with tends to, whether they realize it or not, but engage in market timing. So really saying, well, we think that the market is at a high right now, it's time to sell, or the market's really sold off, it's at a low, it's time to buy. And we'll just bounce back and forth, being in and out of the market. And the hard thing is, over time, it's very difficult to accurately predict those highs and lows. The second is stock picking. So trying to pick the winning companies and avoid the losing companies. You feel like you have more research at your fingertips and can kind of guide that and avoid some misses. And again, over time, that's proven to be quite difficult as well. The third one, and this might be appropriate here this year, is really chasing the hottest funds or asset classes. So this year really has been a year that we've seen a big development in artificial intelligence and in chip companies, and that really becomes something that people are chasing returns through either individual stocks or asset classes or funds. And lastly, making decisions based on headlines. So if you're kind of reading the Wall Street Journal or other publications and you say, well, it's talking about a specific industry or a specific company, unfortunately for most people, by the time the information is out there and you're reading it, all the professionals have read it as well. The other approach is really the evidence-based investor approach. So determining an optimal asset allocation. And asset allocation just broadly is essentially what percentage of your portfolio in stocks, what percentage in bonds, and potentially a certain allocation towards alternative asset classes as well. An evidence-based investor has a structured and rule-based investing approach. So they really take the guesswork out of it, try to simplify things and not have emotions drive your investment process. Broad global diversification. We all realize the importance of not having all your eggs in one basket, especially as these resources are for retirement and future generations and so forth. It's really important to not just have everything concentrated in a few select companies. An effective rebalancing strategy really has been proven to enhance the overall return a bit while reducing the risk. And what do I mean by that? If you had, let's say, 50% of your portfolio in stocks and 50% in bonds, we know that every day those percentages are going to change. The markets go up and they go down. So if stocks really rally and take up more than that 50% portion in your portfolio, you could choose to sell a little bit of that, sell high and buy assets that are low, in this case bonds, to kind of lock in that return and eliminate some additional risks in the future. And if that happened to reverse course and stocks fall, well, you can sell a little bit of the bonds and buy stocks while they're a little bit less expensive. So having an effective rebalancing strategy is also important. And lastly, an approach that's truly supported by academic evidence.
So I think, from an investment philosophy perspective, I think that's a lot to do with the fit long run, right? With any financial advisor you hire, because almost every advisor is going to have some type of philosophy, and whether you align with that or not, regardless of whether it's conventional or evidence-based, is kind of an important part of whether they're going to be a good fit for you, beyond just obviously can you establish trust and rapport with that advisor. So yeah, I totally can appreciate both those aspects, Grant, and think that's really appropriate. So I guess from there, then what do you do about asset allocation, right?
Mm-hmm. Yep. So once you have a framework for your overall investments, how you're picking those investments, the type of approach you have, probably the most important decision then is what is your asset allocation? And again, that means how risky or not so risky are you going to be? And, there's a direct correlation between the performance of an investment, of a performance of a portfolio, and the risk associated with that. So if you put your money in the bank, well, you would expect that it would be there, but you're probably not going to gain a whole lot over time with that approach. If you invest a little bit more in stocks, so you can expect a higher rate of return, even though it might not be the smoothest of rides to get there. So this is a 20-year chart looking at really the two main asset classes, stocks and bonds. So you can see kind of the teal color. The second from the left is the S&P 500 index. It's basically representing large US companies. So that index has achieved about a 9.8% rate of return over a 20-year period of time. That's an annualized number. The navy bar to the left of that is the average stock fund for investors. Well, what does that mean? Investors do make decisions. They, buy in at certain periods, sell out at others. So when we're actually looking at kind of behavior of what overall return did these long-term stock investors achieve, it's about 9%. And that does highlight the fact that it means that over time, the average investor probably isn't the best at timing markets. The same applies for the bond asset classes. So the Barclays US Aggregate Index, that darker red color, about a 3.1% rate of return over the last 20 years. It has historically been a lower interest rate environment until March of last year when the Fed started their interest rate hikes. But over that period of time, again, about a 3% interest rate. And if you looked at the average bond investor return, it's actually slightly negative. And that is, potentially because of a flight to safety. When stock markets are down, people sell out of stocks and buy bonds, and they buy them at a premium because they kind of panic. And also, again, in light of the fact that we've been in a very low interest rate environment. So some combination of stocks and bonds is probably appropriate for most investors. The far right, the inflation number, which has definitely been a buzzword the last couple of years, but the 20-year inflation average is about 2.5% per year. So it's also important to realize, especially for those folks that are in retirement, that 10, 15 plus years from now, the cost of the same goods and services will likely be higher than what it is today. So you do need to achieve some level of a rate of return in order to kind of combat the inflation risk there as well. At the end of the day, asset allocation, again, is important. Diversification, not only stocks, bonds, and alternatives, but also looking at the different subsets, having large companies and small, US and international, growth stocks and value stocks, bonds of different maturities, short-term bonds, intermediate-term bonds, international bonds, and so forth. So making sure you don't have all your eggs in one basket, providing yourself with an allocation that is sustainable long-term, that you're not going to lose sleep over market volatility, but you're going to be rewarded long-term with an appropriate rate of return there as well.
I think it's so important for how you manage an investment philosophy and build an asset allocation. But some will still ask the question of, well, surely things like market timing, that can work, right? So a question to ask, a financial advisor would be, well, does it work? And can you prove it to me that it doesn't work? It's akin to going to Las Vegas. And when someone goes to Las Vegas, a lot of times they might spend 3 or 4 hours playing blackjack and lose a substantial amount, but then head over to the poker tables and win a few hands. And if you win a few hands at the poker table, what do you think is most often shared at the holiday celebration with their family? Well, it's the poker table winnings, right? Not necessarily the blackjack losses. So that element of only talking about the times it worked well and the times that it didn't work well can actually have a substantial impact. So a few of the things, I guess, from philosophical side of things from the Savant end, where we want to pose a little bit of a point to this and something to consider when you're asking a financial advisor about market timing, is whether you can identify discernible patterns from the markets. So there's a lot going on this chart, but this chart really identifies different returns for different asset classes. So what do we mean by that? Well, on the left-hand side are different asset classes. Those are pools of investments that you can own in a portfolio, and they're labeled by color. So US large stocks are dark blue in this example, and something like trend following, which is a kind of a downside hedge on the value of portfolios, that's in the orange color towards the bottom. So all of these have a different color that's assigned to them, and they're all various asset classes that you can own in a portfolio. And then along the top is the actual calendar year, so 2007 all the way through 2022. And simply what this represents is a rank order of the top performing asset class in a given year, all the way down to the worst performing asset class in a given year. So as an example, in 2007, the light green there, emerging markets was up 39.4%. Conversely, global real estate was down 11.1%. That seems to make some sense. That was right on the heels of the Great Recession and what was coming in 2008 and 9, which actually started during the fall of 2007. But some might be surprised at the emerging markets being almost up 40% in that calendar year. And sometimes, if you're sitting there and you're looking at this slide, take a screenshot of this with your phone, because it might be fun to play at your next holiday celebration as a way to have a game to talk about whether you can time the markets or predict the future with what might do well. Because you can cover up one calendar year or show one calendar year and cover up the remaining amounts and try to pick the very best one for the next year. And taking a step back and looking at the full chart, I think you'd agree that there's no discernible pattern. This really looks like a quilt, more or less. And if you take the first few years of this chart in kind of consideration, you'd see, okay, emerging markets is up 40%. That's fantastic. And the market timer might suggest, well, put it all in emerging markets because it was up 40% in 2007. Well, obviously we have the benefit of hindsight now, but in 2008, if you had made that decision, you can look and follow the color. Emerging markets was down more like 53% in 2008. So just at the time you thought it was a fantastic investment in 2007, it became the worst investment in 2008, although nothing was quite good. And then the moment you abandoned emerging markets because it was the worst performer, down 53%, well, guess what happens the next year? It's up 78% in 2009. And that's just the story of one asset class of many on this chart. But the chart kind of implies the point that it's impossible to predict which asset class or asset classes will be the best performers moving forward. Because as you can see, just in this 15-year example, there's never been a repeat best performer. So no asset class has won the day in one calendar year and then the successive calendar year. There's no great pattern. And so philosophically, from a Savant perspective, we own it all, right? So when you're building a portfolio and considering hiring a financial advisor and thinking about whether market timing will work, ask the question of, does market timing work and can you figure it out? We would contend that it's very difficult. Of course, not impossible, right? But you have to be a bit clairvoyant, but very difficult. So what does that mean in terms of actual dollars? Well, this is a 32-year sample size looking at a strategy where someone chooses to try and time the market by predicting asset classes that might do best move from year to year versus someone that simply buys, investments and hold them. Now, what do we mean by buy? Well, in this case, this is simply from 1990 through the end of 2022, purchasing just the S&P 500, never making a decision to buy or sell, and holding that the entire time. And if you invested $10,000 in 1990 in the S&P 500, it'd be worth about $212,000 as of the end of 2022. Not bad. Well, for the case where an individual might choose to time the market and predict which asset class might do well one calendar year and then the next one, the example here is that person is perhaps selling when the market goes down 5%, and then immediately buying back when the market goes back up 3%. So it's always trying to get in or out at the very right time in these different asset classes to see if that played out, providing a return advantage over time. And as you can see, it results in a substantially lower rate of return on an annual basis. And on a dollar basis, just on a $10,000 investment, it's roughly $120,000 difference in total dollar return over a 30-year period of time. And so we can imagine that if there was a large amount of money put in 1990 compared to just $10,000, well, that can certainly have a substantial impact on someone's retirement savings, whether they're living off of it or they're saving for it. And this is why market timing from our perspective is not something you should spend a lot of time with, but it's good to ask that question of a financial advisor because they may be able to suggest that they can. And if they can, boy, we sure would like to know about it as well because it would help us. So having said that, and kind of reflecting, Grant, on what some of the things you had said, a question it might be great to ask is, relative to that asset allocation, how exactly should I invest in stocks, bonds, bills, meaning treasury bills or alternatives? Exactly what should that mix of investments look like? So this is a very long duration chart. This goes all the way back to before the Great Depression in 1926. And it's taking $1 and investing it in different asset class categories. And this stretches all the way through again that end of 2022. And trying to identify where you should be on this line now, right, with the benefit of hindsight, well, you could look back and say, I should have only had small companies, because if I put $1 in small companies nearly 100 years ago, it'd be worth $50,000 today. And that's just $1 of investment. Well, that's, of course, with the benefit of hindsight. And you would have had to go through some very challenging time periods, because if you follow the gray color on this chart, investing $1 in that category back in 1926, well, you can see it was worth almost zero by 1933. And it took a long time to get all the way back up. And you would have had a lot of volatility or bounciness in that line throughout this entire time period. But with taking high risk, you expect high return. And that's exactly what happened with small companies. The blue line represents large US stocks. That's the S&P 500. So that same $1 produced about $11,500, or about a 10% rate of return. But you can see just a little bit of difference in return. 11.8% per year versus 10.1% per year can yield a significant difference in terms of total dollars. So a small difference in return can make a large impact. So the same can be said for bonds, the yellow line. So large stocks in this situation only return just above 10% a year. Well, bonds returned half as much on a percentage basis. And you think, well, half as much shouldn't yield that much difference, should it? Well, you can see $1 invested in bonds earning half as much return over this period of time only actually got you $131 after almost 100 years of investment. So bonds certainly aren't going to win the day in terms of long-term return, but they provide that stability with that asset allocation, which allows you to take risk in large or small stocks. The green represents treasury bills, which for us is kind of the financial services description of cash. So this is money that's in the bank, providing kind of your yield on money market accounts or checking accounts. $1 invested in cash in 1926. Over time, very stable. That green line you see has almost no bounciness, no up or down any particular year. And at the end of 2022, returned about 3.2% per year. And then there's that little maroon colored line, inflation. So $1 in inflation yielded $17, meaning $17 of goods and services was the same thing as $1 in goods and services, almost 100 years ago. And when you look at the difference between cash or treasury bills and inflation, especially after taxes, cash doesn't provide that much more return than inflation. In fact, you probably lose money to inflation after considering paying income taxes on some of the interest you would earn in the bank. So how you exactly deploy your money into the different categories is directly dependent on a lot of different categories, right? What's your age? What's your need for cash flow? What are your legacy goals? How to build that asset allocation is a very personalized decision, but understanding the mechanics of what you can invest in, what it means over longer periods of time, even with slight difference in return, can help build out the best possible plan for you. But it's a great discussion to have with an advisor because they should be able to help you navigate this discussion in very large part. And it kind of dovetails into this discussion around risk. But risk is a loaded question. So thinking about someone that is either leading up to retirement or in retirement, there's the question for a financial advisor, well, how much risk should I take? And a financial advisor's usual response or thought process is related to kind of the red box on the left-hand side, market volatility. And usually when people think of risk in a financial context, they think about the stock market. But in reality, people face many, many risks. It's not just stock market risk. In some cases, it's retiree spending. So how much you need to spend now or in retirement, or how much you need to set aside, quite frankly. So the savings box, if you're saving towards the future, how much do you need to save to avoid the risk of not having enough down the road for either retirement or a house purchase or a job transition where you may need to live off of your investments for a while? That element of savings is also a risk that is a concern. Well, how about longevity? That's a risk. Longevity risk could mean that you either have to save more because you may live a long time, or you could die very young, unfortunately, and you may not have enough insurance to provide your family, perhaps young children that are going to need education costs, or to protect a spouse that maybe doesn't have a substantial income relative to the other spouse. So this element of longevity is also another large risk. And inflation, of course, is another risk, but we'll come back to that in just a little bit. But when we think about risk as a financial advisor, and when we think about it holistically, and when you're asking this question of a financial advisor, how much risk should you take? Understand that that's a loaded question, and it's not just simply about investment allocation. How much risk you should take sometimes is a choice, because it could mean you use things like insurance to offset risk, or you could save more to offset risk, or you could spend less to offset risk, or you could navigate your portfolio towards a certain asset allocation to change or offset your risk. So many, many risks can be faced. And when you're asking this question to a financial advisor about how much risk should I take, be sure to think about all these different areas. And I think once somebody gets to retirement and they've reached the golden sunrise and they're heading for it and they're trying to figure out what life will look like, one of the most common things individuals will ask about is, well, how much can I take out of my portfolio? What rate of withdrawal on a percentage basis is considered sustainable? And Grant, that's a question we get a lot, right? So we're thinking about how to maintain lifestyle in retirement and whether someone can actually maintain it. That idea of sustainable withdrawal rate has gone through about 30 years of analysis and science, right?
Absolutely. And you're right. I think that's kind of the main question that people have, is you don't want to take a pay cut in retirement. You know, you work for 40 years or so, you build up an asset base, and that becomes the main point is I want to maintain my lifestyle in retirement. What's an appropriate withdrawal strategy? And you're right, there's a multitude of studies around that. So we've tried to quantify a little bit here of a few different withdrawal rates. You know, what is appropriate percentage of withdrawal of the portfolio, and what might different withdrawal rates leave in terms of a legacy. So a lot of debate over what is sustainable, different schools of thought around that. It really is or can be greatly affected by a few different things. So first and foremost, the portfolio allocation. So as you showed in that growth of a dollar chart over the last 100 years, if you are, worrisome about the financial markets and put all the money into a bank account, then realistically, you probably have to slim down that percentage withdrawal rate. You're not going to be earning much return over the long term with that type of approach. So having an appropriate mixture of stocks, bonds, and alternatives is really the first starting point. And market returns really can affect the portfolio values, which we're all aware of. But if someone retired in the fall of 2007 and then the global financial markets fell over 50% over that first year and a half of retirement, that's a significant impact overall to the long-term viability of that plan. So it really depends. If you're taking out a higher withdrawal rate as a percentage and you happen to have kind of a bad timing scenario where you retire at the absolute worst time, you retire at the peak, and then markets correct, then that can definitely have a negative impact as well. So if we look at, a few different percentages, and here, if we're just kind of making the math easy, let's say someone had $1 million portfolio at retirement and said, well, what percentage of that can I take per year? So starting on the high end, if you said, well, 6% or more, so again, $60,000 with that example, well, it might be a little bit too aggressive. Again, it just depends on the return over that period of time, also how long someone is retired. If someone is 60 years old versus a retiree that doesn't start taking withdrawals until they're 70, well, the shorter the time frame or projected retirement, then maybe they can take a little bit more. But if you start getting at that 6+%, it may not be sustainable. It's something that requires ongoing, I would say on at least an annual basis, monitoring to make sure that it's still appropriate, that you're not spending it down too quickly. Also, that 6% range may not leave much to heirs, and that might be a goal for some people. It might not for others. So it's just important to have that conversation and see what someone's long-term wishes for the dollars are. And lastly, for this piece, it may need to be reduced in an economic downturn. So if the markets pull back, do you have the ability to kind of tighten the belt a little bit and pull back your spending as well? And so for those folks that have the ability to do that can certainly enhance the overall retirement plan. It can allow them to potentially take a little bit higher withdrawal rate in good markets if they have the ability to cut back when the markets don't cooperate as much. That middle road of about a 5% withdrawal is probably sustainable. Obviously, there's no guarantees in life, but that's something that is more realistic and in target. And over time, you would expect that someone with a balanced portfolio has their ability, by and large, to maintain their purchasing power. Maybe a little bit, above what they started with, maybe a little bit below, but that's probably a realistic approach. Now, the final one we're going to discuss here, the 4% withdrawal rule, that is really what the industry uses as kind of the gold standard right now. So again, you have $1 million portfolio, you take out $40,000 the first year. Every year you give yourself an inflation raise so that 10 years from now you have the same purchasing power in your withdrawals that you do today. And studies have been done for over 100 years looking at kind of rolling month to month 30-year retirements at that 4% withdrawal, and they show to have a very high probability of not running out of money. So these 4% may still be feasible during economic downturns. It's kind of built into the overall plan, so it shouldn't cause too much anxiety around that. One potential drawback, which might sound counterintuitive, but you could find yourself, if markets cooperate and that 4% is reasonable for your livelihood, you may actually leave, quote unquote, too much to heirs. So some people say, well, it's my money, I earned it. I should be able to enjoy it. I don't want to limit the next generation or cause them to not feel the need to work as hard. So that's, again, personal preference. Some people say, I don't really want to leave a whole lot of a legacy, and others say that's my main goal in retirement. So it depends on where you fall, but those are kind of the main withdrawal rates that we see. Again, our kind of ballpark at a high level is 4 to 5% is probably a realistic withdrawal rate. However, it does depend on what your expenses are, how you're invested, what your overall asset allocation is.
So I guess, thinking about sustainable withdrawal rates, it really can be a variety of things, right? I mean, we think about a kind of a financial plan. A financial plan is never a set it and forget it type analysis, right? I think coming back to it, does it allow you to take a little bit more risk or perhaps a higher withdrawal rate if at least you're reviewing things on a pretty regular basis, Grant?
I think that's exactly it. I think that these financial planning items, especially those first several years of retirement, it's important to reevaluate on an annual basis. So sit down, see what has the market done, what has my withdrawal from the portfolio resulted in terms of the portfolio balance? Continue to stress test the plan. Monte Carlo simulations, sort of a stress test measure, are a great tool that can be utilized to sort of determine, well, what's the probability of success given the assumptions within the plan? So I think that's a great starting point here in terms of improving your overall financial health and making sure that you're not spending too much.
Great. Yeah. So switching gears a bit, thinking about asking an advisor about improving this idea of financial health, really important question to ask. So Grant, I'm going to ask you, what can, I do to improve my financial health, and where should I start?
Mm-hmm. Yeah, and I think that that's a great point. Is what pieces are important to the overall equation, and first and foremost, how much are you spending is one of them. But even going beyond really the overall portfolio questions, more the financial questions, the money that you have is really just a tool to help you accomplish what's important in your life. And different things are important to different people. So the first thing that I always say is, well, let's start with your vision. What does your future look like? You're 90 years old. What things needed to have to happen between today and that point in the future that make you think, well, that was a successful retirement? So starting with that vision is very important. Then drilling down a little bit and developing some goals that support that vision. If you say, well, I really want to make sure that I can help fund my grandkids' retirement, well, let's break that down as a goal that, and then take it a step further with the action items. So what does that mean in terms of an annual or monthly contribution to that plan? So really stepping back and looking at the overall vision, what's important to you, what goals do you have throughout the rest of your life and in retirement, and ultimately what action steps are required to help you reach those goals or objectives. And this, the ideal futures process is something that Savant has developed to really ensure that your tailored plan is specific to each individual. It's founded in well-being and values. And again, starting very high level of your ideal future, any strategies that would be helpful, again, from a financial planning standpoint, to help, again, achieve those long-term directives. And towards the bottom here, you can see different values. The very bottom, we kind of color code, what values are important to you from an educational perspective, a work situation. What things do you want to accomplish, or at what point do you want to maybe stop working? Any spiritual goals or values that you have in your life. Environmental being a little bit of a more buzzword here recently. Social things, do you want to be more socially active, join a golf league or what have you? Physical, emotional, and financial. So really looking at all these different pieces, and we've provided a few different things to, values to kind of help maybe position that to see what's important to each individual person. But all of this funneling up, so starting from the foundational part of what's going to help you achieve that ideal future over your lifetime.
Yeah, it kind of seems like a lot of times, just because advisors like to solve puzzles, we enjoy solving puzzles. So often it seems like we're always kind of huddling up towards the top, right? But making sure you're asking a financial advisor about, okay, how can I improve my financial health, and how can it be aligned with what's important to me? Those are important questions to ask. And one of a unique skill set an advisor can have is to help make sure you accomplish that, right? So this ideal future cadence that we have, obviously from a Savant perspective, is part of this, but making sure you're asking advisors these different questions to make sure that that plan is tailored to you. So I guess when it kind of comes back to that team of professionals and what it needs to look like to help an individual move forward, Grant, does each individual person need kind of this team of professionals approach to help make good decisions and move forward?
Yeah, and that's a great question. And it used to be a little bit more segmented. So a lot of folks had, their broker, financial advisor that only handled their investments. And then you had, your CPA that did your tax return, but a lot of times it was kind of after the fact. They received the tax forms once the year was over with, filed a return on your behalf, and there wasn't much coordination. If the advisor sold a bunch of securities and created unnecessary taxes, the accountant wasn't aware of it until it was already too late. Your estate plan, so the attorney involved with kind of drafting the overall documents and implementing things, insurance agents as well. So really there's a lot of different core pieces that are important to someone's overall financial health. And again, the old model is there's a multitude of providers. It's very fragmented, and these professionals aren't working together to provide a cohesive strategy. I would say the newer evolution within the wealth management industry is really, client-centric. So having an individual that has a lot of services around them, and obviously as a financial advisor, the investment management is going to be one of the core pieces, but it's not the only piece. We've talked a little bit about financial planning with cash flow projections, with some of those goals discussions to make sure that they're accomplishing what's important. Taxes as well. So again, making sure that you work cohesively with a tax preparer so that there's ongoing discussions and strategy throughout a year, so that you don't just end the year and you can't go back and do anything to maybe mitigate some potential taxes. And then the other two pieces are really around the estate planning part. So the overall estate planning, having the appropriate wills, trusts, powers of attorney in place, making sure that the right people receive your assets when you pass away at the appropriate ages. So sometimes the default is, well, if you pass away, someone, if they're 18 or over, has the full unfettered access to those resources if they're a named beneficiary. Well, maybe that's not the right move. Maybe you don't want someone having no strings attached at age 18. It might make sense to delay distributions a little bit longer. And then ultimately trust services. So you can name a corporate trustee to kind of oversee the whole process, making sure they're settling the estate, providing distributions to the different trust beneficiaries, filing tax returns, etc. So having kind of one team that can kind of quarterback this whole process, I think, is what is important, but also what the financial planning and investment management world has evolved into. And from a kind of investments alone standpoint, from our perspective, we do have a central investment committee. We look at the investment philosophy, again, as we talked about earlier, not trying to pick winners and avoid losers in terms of stocks or get in and out of the market, but having a disciplined approach to long-term investment management. We do forecast forward-looking asset class returns based on a number of different factors, but we also look at volatility, at standard deviation, to see, well, how bouncy might those returns be? The asset allocation, as we said, is one of the most important decisions that an investor makes, is how aggressive or conservative that they would like to be. And once you have that asset allocation determined, actually picking the appropriate investments to fill out the pie chart. And so that's where this investment committee really does a great job of drilling deep, making sure that those appropriate funds fill in the right asset classes at very reasonable expenses. Ongoing due diligence. So building a portfolio is not a one-time event. So you need to update it on a quarterly basis. We go through a red, yellow, green kind of metric to say, are the funds, the investments in the portfolio still appropriate? Are there any flags that are coming up for us that we need to have on our watch list? And at the end of the day, having the right investments is wonderful, but you need to have the tools to implement them effectively and efficiently. So actually building out and then maintaining the overall portfolio on an ongoing basis really firms up that overall investment committee job.
And I think there's got to be a sub bullet point to this. That's something about, should I have an investment policy statement which kind of governs all of this? And certainly, of course, we're biased that having an investment policy is important, but it kind of helps to answer something like this, right? When we think about an important question, what's always on someone's mind is, well, how will economic downturns impact me? And what is inflation going to impact me both now and in the future? And how do we manage these things? What's the best way to manage those elements? And asking a financial advisor this question can help you understand their investment philosophy and, frankly, their investment process for how they'll manage wealth. And a lot of that should be baked into the investment policy statement, which hopefully is governed by kind of a centralized process. But to give a bit of background on kind of the inflation and the economic aspects, to really just help paint a picture here. Well, a lot has been made of inflation in the last, 18 to 24 months. And this slide is kind of the most recent semblance of what inflation looks like from June of 22 to June of 23. So this is a variety of different goods and services, everything from food to the rent, rent of primary residence, medical care, and of course, fuel costs. And at one point in time, that blue bar on the far left, all goods and services, well, that was 8 to 10%, which is why the Federal Reserve went on such an aggressive increase in interest rates to hopefully curb inflation. Well, the number has come quite a bit back, and you can see the biggest piece of that is gasoline and fuel costs have fallen dramatically from where they were early in the days of the pandemic. But that doesn't mean all categories haven't increased. Not often or regularly we hear from individuals that, well, going to the grocery store is really expensive. Well, it is. Well, food costs have actually increased and still have increased about twice as much as all goods and services when you put it all together. But when you think about all things that can be purchased, either goods or services you may hire out, 3% is kind of the inflation of where things are at today. But it hasn't always been like that. So, we think about the history of inflation. Well, this goes back 50 years of time, all the way back to the 70s. It's been very high. It's also been very low. But over time, it's gone from the 70s when we went through the oil embargo crisis and high inflation periods and high interest rates to really the Great Recession of 0809, where you see a sort of dramatic fall in that inflation figure because inflation went under zero for a while until they leveled out interest rates at the Federal Reserve and hopefully spurred a little bit more people to buy goods and services with cheap debt. Well, there was the spike up in 2020 through 2022. And as you can see, we've kind of come back to more normalized levels now, kind of an annual numbers close to 3.7%. And, when you think about, well, what's the best way to manage this? Well, what does the market expect? A lot of times people think that the economy, so the economic factors we hear about and the market, that they run in lockstep, that the economy is doing well, the market's doing well. If the economy is doing poorly, the market's doing poorly. That's not always the case. Economics is a science of history, not necessarily a forward-looking measurement. So one of the ways that we can identify forward-looking measurements is by the market, because the stock market tends to be what's called a leading indicator. And one of the ways that the market is an indicator here is by trying to identify what future inflation may be. So this chart represents the difference between inflation-protected bonds over 5 and 10 years. Those are bonds that really like inflation. They pay a bit of a yield, but then they add inflation to it, either based on the expectation of high inflation or low inflation, or what actual inflation is, minus what you'd get for just owning a regular, treasury bond. And so when you look at the differences on the far right-hand side, what this chart is essentially saying is that forward-looking inflation, the next 5 to 10 years, although it has been high, and this high, very high in 2022, the market is expecting inflation to kind of get to 2.5% over the much longer term. It doesn't mean it won't be a little higher for now, but it could be much lower moving forward, and quite frankly, lower than kind of historical standards. So that is all possible. That's actually what the market is expecting. So to the extent it's either better or worse than that, well, that can lead to higher or lower stock and bond returns moving forward. And inflation, when you think about managing inflation within a financial plan, within an investment portfolio, you kind of have to look at how inflation impacts different asset classes. So kind of keeping the theme here of what we've talked about with small companies, large US stocks, bonds, and cash or treasury bills, you can see that the impact of inflation adjusted returns, meaning whatever the return was, inflation gets subtracted out of it, that range can be quite large. And the point of this slide is to really illustrate that if you're looking to best curb the risks of inflation in the future, you shouldn't have only money in cash or bonds or a substantial part of your wealth in that area if you're looking to earn a return above the rate of inflation, because there have been periods of time where your return is actually negative. So you're losing money just because the cost of living is accelerating. The best way to hedge future inflation is by having a stock exposure within your portfolio. Now, from an economic perspective, right, just because inflation is high or low doesn't mean we're not in a recession or an expansion. So the gray bars on this chart illustrate, periods of time where we went through a recession. And of course, the other bars represent the changing returns in the S&P 500, large U.S. companies versus bonds and cash. And the whole point of this chart, when you're thinking about this time period of, before the year 2000 all the way through to 2022, the idea is that recessions tend to be fairly short-lived. For the most part, we are in an expansion economy, meaning companies are growing, people are spending. That is most of the time. Recessions tend to be very short-lived, as do bear markets. And if you're always thinking about the next economic downturn as you're planning for your future, oftentimes you're not going to take a next step in action back to your financial plan because you'll be too nervous about the potential of a potential recession in the future. They happen, expect them, as do bear markets, happen every 3 to 4 years. That's part of planning. And when you're asking an advisor about managing inflation and economic downturns, just be sure that they have a strategy to help keep you in your financial plan regardless of this, and making sure that they kind of manage those expectations along the way. It all comes back to asset allocation. So as Grant said before, thinking about the right mix of stocks, bonds, alternatives, it all comes back to asset allocation, because if you don't have the right asset allocation at the beginning, knowing that you're going to have to weather some storms moving forward, then that's probably a mistake that was made on the front end. So ensuring you have the right asset allocation relative to not only your tolerance for risk, but also financially how much risk you can afford to take or need to take, and then your legacy goals. Those aspects really influence asset allocation and should put you in a place where you can weather storms regardless of when recessions happen or economic expansions happen. So to give you a quick example, you think about a $1 million portfolio through, again, this 32-year period of time, and thinking about Grant's sustainable withdrawal rate of 5%, adjusting it for this cost of raise of inflation every year. What these lines represent is essentially the market value of an individual's portfolio over time after accounting for this ongoing $50,000 withdrawal with increasing inflation. And if you don't have, again, kind of this element towards stocks in your portfolio, and perhaps you're very conservative in cash or in bonds, you can see that individuals that don't take at least a little bit of risk put themselves at the risk of running out of money faster. So when you ask that question for your financial advisor, how much risk should I take? This is kind of some of the risks they should help navigate and understand when it comes to market volatility, your appetite for risk, and the risk of future inflation and what it might mean. So we said 10 questions. We did a little bit of extra credit. It's kind of like having a baker's dozen. When you expect 12 and you get 13. Well, you expected 10 and we're talking about 11. So the 11th question, we won't spend a ton of time here, but asking a financial advisor, where will my paycheck come from once I am retired, is a very important question, because it's nice that you've saved it all. And it's even better that if you've gotten over the hump from being a saver to a spender. But the third piece is, where it will ultimately come from and what will the tax impact look like? That's a very unique and personalized process. So this chart really just represents someone's spending goals in the orange line relative to various income sources, what needs to be pulled out of different accounts. But asking a question of where specifically my money will come from, whether it's part-time work, Social Security benefits, pension income, should I take a withdrawal out of my IRA before I'm required to do so? How will taking funds out of my Roth, should that be part of my plan? What about other assets? If I've saved them outside of retirement accounts, should I draw from those sources? Being able to have a good plan in place to navigate these considerations, but also to lower your income tax bill, can really help give you confidence around taking that paycheck regularly out of your retirement savings. But asking that advisor, where exactly will my cash come from once I do retire, and helping to understand, where the income will be driven from, is a very important part of that planning process. So be sure to ask this one as well. And I promise that's the final question we have for each other. So when we think about connecting with you, You'll find in the chat box here in just a moment, which is again towards the bottom of your screen, there's a box you can click and it says chat. We'll be pasting a link there that if you wanted to schedule a complimentary 15-minute call, you certainly can do that. We encourage that if you have other questions that we didn't answer directly here. But if you'd like to do that, we'd love to hear from you. But we'd really like to kind of move on to our questions that we've received from you. So thinking about the various questions here, let's pull up the Q&A box. So Grant, one question I think I have for you off the top here is, when we think about all the various questions we've already asked, there's still the question of like, how do I get started, right? What does this all look like from interacting with an advisor at the very beginning? How do I get started with reaching out to a financial advisor? Can you speak to that a little bit?
Yeah, absolutely. I think that, the first step is, as we said, kind of looking for someone that is a fiduciary that's registered and credentialed, and just scheduling a consultation with them, seeing if it's a good personality fit, learning a little bit about that company to see, if the philosophy is in line with something that you believe in as well, in terms of kind of the long-term approach to a financial plan and the investments. And then usually from there, kind of the next steps are really gathering information. So the advisor, I always say that, more information is better than not. So having the appropriate information of what investments do you have? What is your spending rate? When do you want to retire? What are some of your goals? It's very helpful to have that information to be able to determine if, again, how exactly their financial plan would fit. And from our end, if it would be a good fit as well. So I think just having that initial conversation, figure out the overall philosophy, and then start drilling down on developing the overall financial plan is a great first step.
That's great. Yeah, I tend to agree. I mean, I think you have to start somewhere, and sometimes working with a financial services professional can be a bit intimidating. It's like working with someone in healthcare. You go to your doctor for your first time. It's a bit nerve-wracking because you're not sure what you're going to find out. But having the ability to kind of start that process and feeling confident in it, right? And frankly, finding a good fit is really important. Mm-hmm. Let's see here. Scanning through the questions. So one of the questions here, and I'll take this one, is whether there's kind of a back of the napkin way to figure out how much someone should have invested at the time of retirement based on their own cash flow. It's kind of like a rule of thumb, right? So rules of thumb, unfortunately, in financial services are meant to be broken because there are many rules of thumb that exist about how much risk should I take in my investment portfolio. One rule of thumb we often get asked about is how much life insurance should I have? But sometimes people ask the question of, well, of course, do I have enough? And how much should I have if I retire at a certain age, if I have, different specific circumstances? And when we think about the answer to that question, a lot of it for us comes back to, okay, well, we can run some different analysis on financial calculators to help figure that out based on assumed rates of return. And it gives you an idea. But I think most importantly, when we're thinking about how much someone needs to have, you don't necessarily have to have your number, right? You don't have to have this number you're bringing along with you that identifies the exact amount of money you need at retirement, because your future can be so unknown. But that's the whole point of going through very specific, what Grant referred to before is this Monte Carlo type of analysis, where you're going through statistical probability to try to identify, based on what you have saved today, how likely is it that you will run out of money moving forward based on lots of different individualized circumstances. So I think it's a good question. I also, kind of ask that of your advisor. Do I have enough, right? And they should be able to walk you through an exercise to help you figure that out, whether it's the exact dollar amount or not, and what you were expecting. Grant, one last question for you, and then we'll end today. I've got the question about, all right, 2024 is an election year. Should I be investing any different because of 2024's upcoming election next November?
Mm-hmm. Yeah, and that's a great question. I think that anytime there's an election year, in particular the last few cycles, people think, well, what's going to happen to the overall markets? And while no one knows in the short run, and yes, the markets in the short run are really dictated and driven by these unforeseen events. What we know is that over time, it truly hasn't mattered one way or the other what party is in the White House. Yes, they do have a little bit of power and control over things, but at the end of the day, it's the job of the CEOs of these companies that you're invested in to make sure that their business is doing well and moving forward. So I would not let a short term, we can look at it right now and say, well, there's 2 wars going on, there's an upcoming election. Yes, it can have somewhat of an impact, but I wouldn't let any of these short term issues really drive the long-term investment philosophy. So stay disciplined, stay the course. Really wouldn't use any one event as a material change mechanism there.
That's great advice. Thanks, Grant. Well, thank you everyone for participating in today's webinar. We really appreciate you joining us. If at any time you're looking for more information about Savant or about what we do, we of course would invite you to go to savantwealth.com to learn more. Thanks again and have a great day.